Welcome back. The real estate-focused hedge fund Vision Capital managed to maneuver around the bottomless pits of subprime mortgages in the U.S. back in 2007. A fund they started in 2008 was named one of the best performing of 2010 by Scotia Hedge Fund Index. A report from CBC today warned investors to expect significant volatility this year in the real estate income trust market. So just how does Vision Capital expect to keep the returns on top? Jeffrey Olin is president and CEO of Vision Capital. Great to have you here.
Thanks very much for having me.
I guess we should start right there. Are you concerned about the volatility ahead?
We're always concerned about volatility, but we focus with a longer-term orientation and look for securities that are trading at a discount or premium to their net asset value. Since we can be long or short, we're looking for undervalued or overvalued securities.
Can I ask you about fund flows into your sector, just generally long-short funds? It was a pretty challenging couple of years. Is that changing now? Are people getting a little looser with their capital, feeling better about your sector? Because all of the gating that occurred really put a lot of institutional and retail investors off. Has that changed now?
Well, you've seen a flow of funds significantly into real estate-related funds in 2010. It was certainly fostered by a desire to have a more stable investment. It was fostered by the change in income trust legislation, which really left REITs as the last game in town that wasn't damaged by the SIF legislation.
Let's talk about this thirst for yield. It's been a theme. Kevin certainly talks a lot about it. And we know that investors, after the volatility, after the market correction, really felt as though if they were getting yield, then they were getting something worthwhile. Do you think that's caused some distortions in the market?
I know it's caused distortions, and I think it's a problem. I mean, there's good reason that certain investors need yield. If you're a senior and you need that reliable income, or other folks that need that reliable income, you must have it. But what's happened is yield sells, and there's been a distortion in public markets to those securities that pay a significant yield. I mean, I don't know any business that Kevin or you or anybody has ever valued in their lifetime that looked at how much was being paid out in any one year as opposed to how much is being earned and has been chosen to pay out. I mean, you saw that in income trust situation where folks were going to the bank to borrow money to pay distribution because it was selling.
I think one change that has occurred, though, to be fair to the value yield investor segment, which has actually outperformed pretty well everything in the last couple of years, is there's a lot less leverage or borrowing of money to do exactly what you said, because most advisors and their clients themselves have learned that debt can really hurt you sometimes. So are you feeling any better that companies are more concerned about how much debt they're putting on their balance sheets? Even in the REIT space, there's some concern about how much leverage is used in the Canadian REITs.
I think that's fair. I think that the leverage limits are pretty sound and they're not out of whack, but you're still seeing REITs, particularly in Canada, overpaying what from their cash flow. They're paying a distribution that is too high relative to the distribution or the earnings that they're making or the cash flow that they're generating.
Let's talk about if there is a kind of a distortion or a bubble in yield. Does there? I mean, you could foresee a time when when the economy started growing strongly post-recession, markets started to take off, and the notion of growth actually came back into the markets. The capital gains would be what you're after. Do you think that retail investors are the last ones left holding that bag, and sort of as money managers move out of yield and into growth, it leaves some people behind?
To some degree, but don't forget some of the institutions, quote, institutions out there are just an amalgam of what the reflection is of retail investors. Yep. So institutions create funds that sell to retail investors. They're called an institution, but it could just be an income-driven investment, and they have a package of yield securities that they must put into their fund because that's their mandate. So I don't think it's just retail investor, but I think the retail investors are the ones most at risk because they are very susceptible to the yield story. I mean, in our space, in the REIT space, you saw in 1 week this year, a whole year's worth of return was yield was wiped out because, REIT prices came down 5%.
Well, I'm one of those people that's guilty of providing product with yield, and here's what I found. I'm going to blame the government, and here's why. We had over $140 billion in income trust and REITs in the last 7 years evaporate in the last 3 as a result of government policy. That was what was funding the lives and lifestyles of thousands and thousands of Canadians that were north of 50 years old. What else are they going to want except yield? They have to eat.
Well, I don't share that view. I think that the government did a good thing. I think it's proven that it wasn't the big problem that folks thought it was going to be the case. We've seen the good trusts evolve into corporations, continue to maintain a reasonable dividend, and they now have attractive dividends. We haven't had the devastation. We've had some transition, and it hasn't been the bloodbath that people thought would be the case. And I think it proved the government policy was prudent in that regard.
One of your funds, Vision LP, had an 85% return over 2.5 years. Am I reading those numbers?
We launched July 2nd, 2008, and the most current numbers off the top of my head, we're up 108% net of all fees and expenses since July 2nd, 2008.
So give us a sense of how you're positioning that now. We just had this whole conversation about, are we moving out of bonds and back to equities? What's your positioning?
Firstly, to the yield question, we look at total return. Certainly yield can be a component of it, but we're looking at capital gains as well as yield. We're still finding securities that are trading reasonably well priced. In other words, we're buying some stocks that trade a substantial discount to the net asset value of the real estate underlying them. And so we continue to be quite bullish. The fundamentals in Canada, I'd emphasize in Canada, are sound. Supply and demand is in balance. We've had limited new supply coming on stream, and so we continue to find compelling investments.
We're out of time. We appreciate your time today.
Thanks for having me.
Jeffrey Olin, President and CEO, Vision Capital. It is